Okay, so its build has shown large growth and predictable companies will make up 51.7% of the portfolio, as they are the surest investment you will have in this portfolio. Because look, when it comes to investing, though sometimes you can have businesses that have really a lot more than one category to them, but a few businesses that you will come by, they're one going to be so predictable that you're going to see that it's very easily seen that they're going to be able to coin money and still have this high amounts of demand with enormous amount of product value or service value that their customer would really never want to go anywhere else besides to their products. And their products are also constantly evolving and wearing with high demand on the new or evolved products to user interface or items you use a lot and becomes compatible with a lot more. And the products have new ways to form things and how to move them, also how to store them in a more efficient way, than the rest of the other products with all these sort of unique product values. All products that they've made have created a lot of innovation value too. So you can see by this example of what I'm explaining, that type of business has really the quality of a high, large growth business, a predictable business as well. And it also has a deep value business model because surely that people are going to come back no matter what, right? And depending on the item that they're really not going to switch with anyone else or anything else, regardless of the circumstance, because of how unique the product or service is, or a unique approach that makes the customer not want to switch as it will be undesirable, lacking, or very inconvenient. This is the quality of a deep value company too. So you can see this makes it a deep value because of that sort of loyalty of unswitchable. People call it brand loyalty. There's many names for it. It's that unswitchable product value that customers will never switch between product per product because it's inconvenient, it's undesirable, it's probably painful too to do that. That's a deep value company from their brand. And they're a large growth company as well because of their highly demanded products that are always constantly used at a higher base, right? Because that's the thing. A deep value company is just a company that's products are used all the time, almost all the time. A large growth company is a product that's used actually a lot more in usage. So it's a product that's mostly used a lot of the times and is constantly innovative, and the usage of it gets better as time goes on, right? The product value gets better as time goes on, becomes more compatible. The user interface improves. There's more technological innovation inside the product as time passes on, right? So this creates a big product value or service value within the company that increases in its growth potential from this product formation of constantly evolving it, but even so having their existing products to have still that ridiculous obsession usage all the time, right? So I just wanted to distinct the difference there because a deep value company obviously can have usage, but it's most of all a company that is just a model of needance for usage. It's not a company that's usage in fully almost all the time, right? That's used almost all the time. A large growth company does. A large growth company is a company that you use the products, right? And you use it to the full usage and you want to use it to the full usage. And it's really the only company that you use for that subject of that usage fully and you don't go anywhere else. You see how that kind of mixes and matches with large growth company primarily, but also deep value company, right? And the predictable part, it's very predictable because of these two things. These companies are very predictable because of their existing products. And if they just keep doing what they're doing from the innovation, nothing that they have to change the world even if they do, but even if they stick to not even changing the world, they will make a ridiculous amount of money. These are the type of businesses that I put one of my highest allocation capital to because they have the biggest cinch, right? For some of you who don't know what a cinch is, a cinch is referred to an extremely easy task. It's such a simple, good deal. Or it stands for it's such a secure, certain deal, like a compartment, like a belt. Like it's so sure. It's the biggest cinch you can think of or invest in. The easiest, most secure, most firm investment you can get. A company so sure, so innovative, so much dominance place needed for customer that it's too undesirable to not have their products or services at least every few days makes it a giant reliable brand. Let me go back to the previous slide too. Look, you want to know, I'm not telling you to invest in this company, nothing like this, but I'm going to tell you the company that's a large growth, a predictable, and a deep value business. You want to know why this device, most of all its company, Apple, is a large growth, predictable, and a deep value business? One, it's a large growth company because it's mostly used and highly with the products, and people use this product every day with a full usage, right? They use it, they occupy their time, majority of all the time, inside this device right here, because they have everything here. And these products are constantly evolving with higher user interfaces, higher compatibility, higher technological hardware in terms of connection, more applications, and yeah, overall compatibility, right? So from that too, it's a very predictable business, because if Apple just continues what it's doing without super high innovative things, right? They don't have to make super, like, they don't have to make, I don't know, some hologram in the future. Like they can just stick to continuously making still other products, but still continuing their iPhone and evolving their iPhone, right? Just continue what they're doing, and they will make still a certain amount of money. They will continue to do so. So that makes it predictable. A deep value company. The reason why this is a deep value company is because it's a product that you use every single time. Every single time. You cannot look. People would rather sell their car than sell their iPhone first. That's how valuable this thing is now. I can't go anywhere in the world without seeing someone looking at their phone. And every time I go to the gym, I always see at least quite a bit of people with their phone like here. And when I see that, I'm like, keep doing that. You're making my investment go better. So you see, it's a highly reputable brand. It's a huge brand. It's a monstrous brand. It's a titan. This is a titan of a brand. You know what it would take to dethrone Apple? It would take, Apple is the strongest brand in the world. It is, without a doubt, because it's something that you use every single day. And on top of this, it's really the biggest needed item / want item, because nonetheless, this is an essential item. You can't go anywhere now without an iPhone, because everything is digital. And on top of that, you can't even be involved technologically with innovation as much in terms of new internet services and new applications without primarily an iPhone. Right? Many people can use a computer, but many people, you're not going to always bring your computer everywhere. And to be quite frank, it's much more easier to get your phone to use the internet, right? And Apple is the biggest and most used and most highly valuable phone company in the world. That's just the way how it is. So think about, they literally own the biggest market when it comes to having still in touch with innovation in terms of internet services, applications, and anything that revolves around the internet. Including with this, people put physical information, almost 90% now, information is now in the digital part. Where do people look at information now? They look at it in their computer, but more than 50% of the times they look at it in their telephone. So you see, it's like it's mostly everything to this one product that makes it a deep, valuable company. So I just wanted to show you an example so you can have a rough idea of how these companies really go into each category. And also, you're going to have maybe some deep value company that has also a dividend as well. Most of all, those type of companies who are half large growth, half predictable, and half deep value, those are the companies that I put the biggest allocation to, because they're the surest investment I can ever do. Like what other better investment can you possibly think of besides that has all those three things? Not anything really when it comes to a business. The highest amount of allocation I put in is about 6 to 7%. For the rest, I don't put that type of allocation. For the rest, like for example, for dividends, or for regular predictable, I put in, even for the best companies in the world that have such a cinch, I put in max 5% of my account or of my portfolio. Still on sure cinches though. Here's a great way to think about it. If you find 5 businesses, 5 amazing, great, valuable businesses, and 3 of them are such a cinch, right? But if you find 1 out of 3 of those that are the best out of the 5, that you really understand more than the other 3, that's the one that you should invest in, and ignore the rest of the 3. That's the way how you should invest. You find 5 great companies in an industry that you understand very well, that are amazing, phenomenal companies, and you take 3 that are much better, that you understand, that are overall much valuable in their products or services, and have a more unique approach. And out of those 3 companies, one of them you understand the most, that have more valuable, that you can see what I mean by understanding is that you can see the prospects of it making money more in the long term than the rest of the companies, or that has more valuable, let's say, characteristics than the rest. That can be brand, that can be product value, that can be service value. I would say that what comprises most of all for your switching as a so-called understanding is the underlying product or service that they provide. So if you find that that one company out of the three has a much better product that you see, much better service from their value independently, to over control things, whether that product is completely from the large growth, predictable, and deep value company, then you switch to that and ignore the rest of the two. Even if they're really good businesses, you don't have to invest in the other two because you already have that one. There's no need for the other three because they're still better businesses. For the lower allocation category, such as speculative growth and turnarounds, you'd want to allocate max 3% to any one company in those categories. So that's in general a very fundamental way to make a diversified portfolio. Now, there are alterations that you can do depending on your risk tolerance. One of the things I would recommend if you want to do this is, let's say that you already have a few deep valuable companies that are simultaneously large growth and predictable companies. It's really the same to owning a deep valuable business as well, right? So you already have large growth, predictable, and deep value company type of business all into one company, right? And you have those type of businesses. You have a few of those type of businesses. So the best approach to this is if you're going to build your portfolio like that, which I strongly advise you to do, is if you have three of the same category type of companies, which are the strongest company that you will ever invest into, it's sort of pointless then to have many deep valuable companies because you already have deep valuable companies. What I would say is that if you already have several, I'm actually gonna call this. So yeah, you know what? I'll call this the top A businesses. So I won't have to keep saying large growth predictable, right? Whenever I say top A business, it stands for a business who has the large growth, predictable, and a deep value business. What I was saying is that if you already have these top A businesses, it's sort of pointless to have several deep valuable companies into this category still. What you can do now is that instead of having several here, just minimize them. You don't need that much deep valuable companies because you already have them as the top 8 businesses. So what you can do is, let's say you can max to only 2 deep valuable companies or 1 deep valuable companies because you already have the top 8 businesses. So by this nature, if you know that the absolute best 2 deep valuable companies that you know so certainly, they're the 2 best branded companies in the world, that it's almost impossible soon for something to take it down. These 2 can have 1. What you can do is that these 2 can have 1, both, you can split the same percentage. What I'm basically saying is when I say A businesses, I'm not talking about large growth, predictable, deep valuable. I'm just saying that it's just what the business is called for just the deep valuable segment, right? So if you already have several top A businesses, it's not necessary to have many deep valuable companies. So this is what I'm basically saying. The way how you can construct your remaining deep valuable, just solely deep valuable companies, is by having 2 companies that are the best branded companies in the world, and it's impossible. You see that it's almost impossible for something to take it down. So the first thing you can do is you can split half the percentage, so half of 11.8% for each of the 2 companies. So the first company will get 5.9% and the second company will get 5.9% as well. Or 2, the first company, let's say you understand more. So A business, you understand more and has more qualities than B business. So you can either add a 7% to A and 4% to B. Or you can really just exclude B completely if you really understand A more and just keep A and just allocate 11.8% to just A. Because it's such a business you understand so well that there isn't really a need for B, that you can keep all allocation to A. I know that that's a big allocation. I know that. But look, these are pure, deep, valuable businesses. It's a business that's going to last so long and is so engraved heavily in society with resilience all the time to any world pressure that usually these are really what I call turtle businesses. It's a business that will last so long that it will be so wise as a turtle. Now, it doesn't mean that the turtle can't die, but that will happen a long time from now. And the chances of a turtle dying is much more lower than maybe the chances, to be honest, of a top A company. A turtle is heavily engraved. Remember that a deep valuable company is mostly a company that's the mostly engraved in society that people use. A top A company is also engraved in society, but they're a valuable product. They're not engraved into all segments. So by this nature, if something's engraved by all segments, it's very hard for something to die until it eventually dies when there's actually innovation. Doesn't see the need for it to be obsolete. That was the case for horses, right? But you have to recall that innovation takes decades to master in order to make an existing item or an existing service or product obsolete, because they have to completely change society's usage as so much innovation to go to this new area. And that will always happen, but that takes decades to move to society slowly to innovation, to more technology complete based products. It happens every day, but it happens very, very slow in someone's lifespan. So by this nature, this is why it's really the surest investment too. I know that I said that surest was the top 8 businesses, but that's in terms of getting a return so sure. If you want to look at a return so sure in the very long term, there's nothing better than a turtle company. But that will happen from a long time from now. I mean, by the time you're pretty old. So these companies are actually partly called turtle because of how slow but steady ensure they can make more money and continue to do so. So it's logical to actually have a more allocation in these businesses, not because of its industry type, but its full business, such as the brand that acts as people's limbs up to that point. Like, it's such a strong brand that it's a part of people's arm. Like, it's something that people use every day, that it's just crazy and will catastrophically affect people's lives if people aren't using it anymore. So there has to be something to replace that needness. Innovation, but innovation takes decades. So within these decades, you can benefit on that type of investment. Now, there's also a few modifications you can add to this layout. And people are gonna like these sort of different methods because each person has a different goal, right? So let me show you what it looks like. Okay, at the end, you can see what's changed in this graph. ETFs. ETFs went from 8% to 20%. But look, at the end, from investing in the S&P 500 is for sure the surest investment you're ever going to do. And it acts similar to a deep valuable company, only that it fluctuates a bit more in the short term. But in the long term, you can have not much of a different return from investing in the S&P 500. And this time, though, you're really almost guaranteed to not fail. This will act as a counterbalance between your investment, whether the company went sour too. But the industry went through a struggle, let's say, net the S&P 500 will be in effect by any companies, but not by much, probably by a small drawdown, because remember, the S&P 500 isn't just filled with one sector. It has all the sectors, because it's a portfolio of the 500 biggest companies in all sectors. So when you're buying the S&P 500, you're also buying really a portfolio too. So by doing this, you're actually adding a portfolio position inside your own portfolio. Because at the end, it's invested in the 500 biggest companies in the world, and so are you taking ownership to, by buying the S&P 500, to owning all of these 500 biggest businesses. So you're going to own Intel, Microsoft, Amazon, Google, Metaverse, Starbucks, up to a very speculative company like a healthcare drug manufacturer or Teladoc, right? You already have all these companies here. This is a great way, if you find it more practical, to just hold the S&P 500, or a more cost-effective way. Now, keep in mind that I'm going to show you a few different modifications you can do to your portfolio, but I want to let you know that each of these portfolio allocations are not better than each of the ones I showed you. They're better in terms of what your goal is going to be, right? So this is why I'm saying this is a great way, if you find it more practical, to just hold the S&P 500 to be more cost effective. Now, this way is not better than the last. It's just another option if a person feels more comfortable owning more of the S&P 500, but really there isn't much of a difference. Probably the deep value company will make more in the long term compared to the S&P 500, but the S&P 500 though will give you the more sure cinch from eliminating any of your miscalculations, because you're really investing into the economy. Now, you can also eliminate the deep value companies, the dividend companies, the turnaround companies, and speculative companies. You can allocate about 48.3% if you wanted to put it into the S&P 500, because at the end, it's a very sure investment. It's the most sure investment you're ever going to do. And I know the sure investment was in the businesses, but in terms of just general investment, really the most sure investment you will ever do is in the S&P 500 if you really do not want to lose your money, right? But you have to sacrifice a big portion of your returns if you want to invest in the S&P 500, but you will get a guaranteed return if you want to. If you're more inclined to that, you can then invest 48% into the S&P because it's a very sure investment and where you will be fine with more. But just keep in mind that the S&P 500 is not invincible. With this sort of allocation, you shouldn't then be surprised if your portfolio went negative in the short term, because by this point you are widely still spreading, right? You're still spreading, but you're still benefiting a lot more in the long term from the S&P 500 with a sure rate of success. But you're going to have a lot more volatility in your portfolio, in your diversification, because if the market goes down by 20%, if the S&P goes down by 20%, you will lose about total 9.6% in your portfolio, which is still very low, but still shows you how much you're concentrated with the S&P 500. However, I do want to let you know that that's a bit black and white, because you can be making that loss in the S&P 500, but at the same time, these other many different companies over here, maybe you might be making a gain, right? So maybe this might be, instead of 9.6%, maybe you might be losing 4%, because you're still gaining here and you're losing some here, but you're gaining here. Net in total, you're able to mitigate the loss of what you're taking into the S&P 500. It depends, but this loss will be mitigating with other investments you made with a huge return. I would say this is the best approach if you are absolutely not wanting to lose your money, like whatsoever, in the next 10 years. If you're literally petrified, if you're terrified, if it gives you anxiety to think of the possibilities that you will have a drawdown in the next 8 years or 10 years by any means, like if, I don't know, but I mean, you're going to have a drawdown in a very diversified portfolio, but that will happen like a huge drawdown. Really, if there's like a World War III happen, including a Great Depression with a pandemic, like that would literally cause your portfolio to go down up to that point. But even then, I think you'd even break even, right? So, and not even, I'm just saying, so you won't be scared. I'm just saying that you will break even if the price of what you bought 10 years ago, 10 years later, it goes down so sharp that it goes right back to the price you bought 10 years ago. That's just what I refer to. But that's never happened before, not even in the Great Depression, because the Great Depression went down by 50%, right? So if you bought the market at, for example, $10 and it went up 10 times, it went up to $100. If the market goes down by 50%, the market went down by $50. But in total, you're still making 500%, right? So the market's been open for about more than 120 years, and that's never happened before. So the chances of that happening now are still, it's about less than a 0.1% chance can happen. But again, if you're petrified still of, literally, if you're the most anxious person that does not like to see any sort of drawdowns whatsoever the next 10 years, then this is really the only and best type of diversification you can have, right? Just keep in mind though that you have a much lower return in those 10 years than the other type of diversifications I showed you, because of your wider allocation in the economy rather than really a few concentrated allocation to these fantastic companies. Plus, this is really the most diversification safe you can ever get in the market. There's nothing else better than this. There's nothing more. The S&P 500 is already a whole portfolio of a very strong and steady spread of the 500 biggest companies in the world. That's how much diversification can you get more than that of 500 biggest companies? So 48% is in these 500 companies. You're already diversified up to your last name. I mean, so this is a game with this portfolio that you cannot lose, but you're going to make a much less return compared to a person who's concentrated a bit more with companies compared to all their money, almost half of their money, into the S&P 500. But you'll have a much more sure return than the person who doesn't, who did the first portfolio, or even this one. Remember that the S&P 500 though is mostly a way of investing and knowing that, look, the whole point of investing into the S&P 500 is that it's to understand that you never know what will and what won't work. Like what company will work and what company won't work. That's the whole point about the S&P 500, why you would invest into it, because you never know what will and what won't. From this allocation, this already gives you the exposure and eliminates all that type of thinking, because you're going to really gain on a company that you didn't even believe in. Like, let's say a company that you really did not believe in, that it will make more money, right? And that you proved it wrong, right? But let's say that company made more money and it kept doing more money and it proved you wrong, rather when you first proved it wrong. And that can happen, right? That's why this eliminates the way of thinking, like you don't know what will work and what won't work. While simultaneously, the S&P 500, you're also gaining on the company that you believed in and that you proved right. So it's funny, right? This is why really the S&P 500 is one, the surest investment that you will ever do that you won't lose money on. And, two, you won't make much returns in the short term, but you will make rocket returns in the long term. And three, it can give you the widest exposure of risk deflection per sector, per business weakness, and per business boom. Again, you're betting really on the economy here. This is really the economy, that it will do well as time goes on in the future. But there will always be ups and downs, remember. There will always be ups and downs in the markets from anticipation from the economy. Because the economy anticipation can go anywhere. People can get scared, people can get greedy, from macroeconomics to geopolitical to pandemics to shake the markets temporarily. But people will consume, remember that people will consume more and more and more than they did the last decade, because companies will make more valuable products as time goes on. And innovation, if you're a person who believes that innovation will evolve more and the humankind will evolve more, the economy should go up relatively, right? I'm talking about the US. I'm not talking about all other economies. I don't know about all other economies, but I'm talking about primarily the US. And the S&P 500 is mostly comprised in the US. And even so, it just takes the 500 biggest companies in the world. This will already give you the most diversification that you can ever think of when it comes to diversification in the markets. Remember, I just want to let you know though, that remember, you're not here to make your portfolio look nice or rather it to look beautiful or whatever. No, not at all. You shouldn't care about that. You should care more on whether you're making a great investment return, rather making a great investment return nice for yourself, not to your investors, because you're not a hedge fund on Wall Street. You don't need the Sigmas or the 300 asset portfolio unless if you're leaving an inheritance for your great grandchildren will use. But in any case, you shouldn't mind a little volatility in your portfolio, even with diversification, but rather mind more that you're actually making a fantastic investment in the first place for the long term. You don't want to look pretty. You want to be pretty, right? Because you don't have to worry about selling to 401kers. I don't know how many times I've probably criticized Wall Street, right? I think I'm in Wall Street's hit list, to be honest. Look, there's a lot of great companies in Wall Street. Like, there's a lot of hedge funds too that I admire and that I respect completely, like Bridgewater's Associates. That's actually Ray Dalio's hedge fund, right? His hedge fund is a very powerful hedge fund, right? And the way how Ray Dalio invests is in 500 different assets, right? And I don't have a problem with that because he's actually a really good investor. He knows what he's doing, and I respect that. Same thing with Lee Lu. Same thing with Mark Howard. Any of these people. Same thing with Warren Buffett. But there's some institutions in Wall Street that have this ridiculous type of way of investing that is so unnecessary. And the reason why they constructed this way, from having so many different assets, is just to sell to more people. So it looks more promising, right? And they have to keep their portfolio this way because they have to keep up a positive, as much as possible, positive performance every year, which is ridiculous because that's almost like, remember, it's like what Warren Buffett says, it's like saving up for sex for your later age. I mean, it's a stupid thing to do. It's the same thing like this. Like if you're really trying to look for a positive, if you're really trying to look for mathematically how to make a positive portfolio every single year as time goes on for the rest of your life, it's almost like saving up for sex for your elderly age. I mean, it's an irrational thing to do, because you shouldn't. Why would you care about making a positive return every year? You should care more about making a better return in 10 years or 20 years, or even in the first place to even make a return in 10 to 20 years. Most of all, to make a fantastic return because you made a fantastic investment decision on a business. So look, we've pretty much completed in general all the basic concepts to construct your portfolio depending on your goal. So the first one was this type of portfolio. The second was this one, which had a bit more concentration with the S&P 500, and this one has almost half of your portfolio into the S&P 500. So we'll talk about which one is better depending on what you want. The first method, this is really the most traditional method of diversifying and where you can hugely mitigate your risk per year. This is the best approach if you're really looking for a consistent return every year on your portfolio. Since you're widely spread per industry, per sector, per business, and per allocation, this is really the most diversification you can get in terms of a portfolio when it comes to every year performance. If you're looking for that, if you want to make a great return, this will make you definitely a great return. And this will probably make, I'm not saying that it will, but it will probably make a better return in 10 years than the rest of these other portfolios, because you're investing into individual companies, right? And by better businesses, they'll make more money than all the other 500 companies, right? So It depends what you want, right? But you won't have the surety in the 10 years that you will have actually 100% of your money back because you're not widely into the S&P 500. But you will maintain a positive portfolio. I would say that that's very hard for that to happen because of your diversification. You're entering into many different things, many different assets, many different sectors that I would say it's a 99% chance, like it really is. It's a 99% chance that you will make your money back in 10 years. But if you still can't deal with that, if you just really do not want, no matter what, like a doomsday portfolio in 10 years, that's the case. But this is still, I would say for anyone, this is the best one to use. The second one, this gives you the ability to still earn the wide diversification, right? But you have still the surety for the long-term investment if you're looking for a stable return, not per year, right? So you're not looking for a stable return per year, but you're looking for more stable return within 5 to 8 years. So this one, this is the best approach if you see that you can understand more of having a bit of the S&P 500. But for the long term, which can give you a better expectancy of the return that you can get than rather the other categories. But you will actually still simultaneously still want to keep, let's say, your portfolio as wide as possible per business and sector, so you won't get affected as much in the short term. This method, I would say that this one is the best if you really don't see much of the point of owning the deep value, because at the end, the S&P 500 is almost the same as the deep value. So let's say that you would rather put 20% into the deep value and still earn interest income like dividends, like cash flow, still have startup companies or companies changing things and have a big portion to large growth and predictable. You can do it like this, right? But keep in mind that by this type of diversification, you will be a little bit more prone to market fluctuations, and where if the stock market, if the S&P 500 goes down by 20%, this entire 20%, right? So let's say you have $100,000 and 20%, 20.4 would be $20,400. Let's say the market goes down by 20%. Okay, so your portfolio would be down by 4%. You see, that's nothing. That's nothing. By 4%, your portfolio is down by 4% just in here. But in the rest over here, let's say you're out by 10%. Right? And that's a very, very low percentage. That's a very low percentage gain for the rest. But let's say I'm giving you a worst case scenario, you would still be positive by 6%. So you see, this is a great approach if you say want to have a bit more of the S&P 500, but you have to be able to expect to have possibly a negative return in a year because you have 20% to the S&P, but you want to get a more stable return and eliminate your folly by every year, right? This helps a lot if you want to mitigate the sour investments that you will do, even though you won't make any sour investments. But if you're a person that, I don't know, if something happened, right, this will help more mitigate those type of investments, right? So it depends what you want. You see that there's not one that's better. It's just that this one gives you the surety, but it gives you lower return compared to this one, right? And there's a 99% chance that you will make a return using this. Same with here. This is almost 100% chance that you'll make a return with here. And this is almost exactly 100% to make a return in 10 years. So it depends what you want. So I really recommend it. If a person's petrified to lose their money, do this portfolio. If you're absolutely, no matter what, if the world comes to an end and you don't want to lose your money in 10 years, you by no means use this method. Now, this is by having half of your investments into the S&P 500. This gives you this enormous amount of diversification in the long term, in which by nature, you're going to have for sure a return much more steadily in the long term. This is the best approach if you want to actually get a return, no matter what the return is, but get a return in the long term, whether it's a little, whether it's a lot, but actually get a return. Well, you will get a very big return because it's a long growth, predictable in S&P 500, but you won't make as much compared to here or as much at all to here. But still, this will be a big return. But if you want to actually get a return in the long term, while still having a bit of diversification with not much extreme volatility, but you're fine with the volatility in the short term, that if the S&P went down by 50% in the short term, your whole portfolio would be down by 24% in the year. But this can vary really, since you have other investments on other industries that can offset that drawdown for the market, since you have each industry, each sector. So each industry can be down and some up. So your drawdown should be somewhere around 24% still, maybe 20%. However, in drawdowns, remember that in drawdowns, they're temporary. And look, remember, when there's a drawdown, there are huge opportunities to buy businesses at a huge discount. They're huge opportunities that you've been waiting for, or the businesses that you already have that are selling you at a 50% discount of what was at a 20% discount before. That's a bigger incentive to invest more. Because remember, when a business is selling at a 50% discount, there's actually a 100% guarantee that you will make money. Why? Because if something is selling at $100 and it goes to $50 and it's worth $100, and you buy it at $50, you're guaranteed to make $100. Not because I think so, but because the company's worth $100. So when all this stupid fear goes away, when people realize that there's not much fear much about, the company will go back to what it's worth. So you're guaranteed to make 100%. That's the way how I always think about investments. The more the company goes down, the more guaranteed returns I'll make. So I actually invite for the market to come down, right? So that's why to me, this sort of diversification really does not matter. I don't really care about much of this or this, right? But many people will. Many people will in the short term, and many people don't even want to stand losing money in the long term, right? So that's why I created variety. But to a person who understands what I'm saying, but still does not like to lose, still does not want to lose money whatsoever still, because that's what diversification is for about. You still do not want to lose money, whatever, still, no matter what, even though you won't lose money, but you still don't want to lose money, even though you're completely overkilling by diversifying like this to not lose money. This is the best option, right? But if you really, really do not want to lose money here, if you really absolutely, no matter what, everything dies, this will give you that sort of gain. Now, remember that the drawdowns are opportunities to buy businesses at a huge discount, which increase more the level of return you can make for your investments. And remember that this overall will make you a lower return compared to the rest, but it will make you still an extremely big return nonetheless. So can you imagine the big return here and the big return here, or even a big return here? So either way, it's up to you. It's your general preference. All right. So we've already kind of covered up all different types of diversification methods. This was a lesson more of fundamental. In the next lesson, I'll start to talk about more, because I already talked about the diversifications. You guys already have the diversification part. In the next lesson, we'll be talking about actually now in the business, what you will want to be looking for, what to look for a business, and also those principles of large growth and predictable. That goes with any sort of way of investing. Yeah, we'll talk about in the next lesson how to find these companies, what to look for, what to not look for, what's a red flag. We'll really delve down in the next lesson, really what's actually important in investing, like how to actually find a really good company. All right. I'm pretty sure you guys are gonna love that. All right. So I'll see you guys in the next lesson.